Morning, everyone. I'm Greg Faranello, head of U.S. rates for AmeriVet Securities. Welcome to Monday Minutes. What a difference a year makes. Year over year, you look at where the markets were at this time last year, you look at where the markets are today. The transformation is nothing short of astounding. Last year, we were headed to 3% as the effective funds rate. Today, we sit at 150. The markets are clearly in a much better mood. But more importantly, some of the events that we've seen, I think, over the last 2 to 3 days are very significant outcomes. You look at what happened in the UK with Boris Johnson, you look at Brexit, you look at US-China, right? The anxiety over, are we going to move forward, are we not going to move forward? And then, of course, the Fed's balance sheet with regard to repo. Now, none of these things are perfect. They're not necessarily perfect outcomes, and there's still a lot of wood to be chopped, I think, over time. But the reality short term for the markets, when you look at it on a relative basis, are very constructive. And we think the setup heading into 2020 is actually very, very good. So over the weekend, we were quoted in an article alongside Rick Ryder from BlackRock. And Rick's a legend in the fixed income space. And we sat down with MarketWatch, and the conversation was really about what do you think in 2020 going forward. And so we look at the market this year. We look at the extremes really back to August of this year, 2019. We continue to pivot back to 2015-16 for key levels and really some of the same key dynamics that are around us right now in terms of the participants and the players in the marketplace. And we see 2020 as an opportunity for the market to continue to work off and see an alleviation of some of the conditions that held us back in 2019, right? So what does that mean? So in rate space, we would expect the 10-year to try and test the upper bound of 2%. We've been trading 150 to 2%. In curve, we expect the curve to be largely directional here, meaning if rates rise, we would expect the curve to steepen. If rates move lower, we would expect the curve to flatten, more so off the back of the fact that the short end of the yield curve is anchored here with the Fed's current posture. And we also feel that the dollar has the potential to depreciate moving forward in 2020. And that call is based less so on interest rate parity and interest rate differentials in a world of flat to negative to zero interest rates. It's really about relativity in terms of economies, right? So the beneficiary of a strong dollar over the last couple of years now could not necessarily signal that the U.S. economy is doing poorly, but that the global economy perhaps is starting to show signs of recovering. I'm Greg Faranello. This is Monday Minutes.